Welcome to the SaaS Revolution Show, a podcast by SaaStock. Here we interview SaaS founders from around the world who've been there and done that, as they share the ins and outs of how they built their businesses, their operations, their path to securing investment, and more. Our mission with the podcast is to help you, the founder, learn how to scale your SaaS, maintain your well-being, and navigate the complexities of this ever-changing industry. I'm your host, Alex Theuma, and together we'll explore the good, the bad, and the ugly in the journey to SaaS success.
Welcome back to the SaaS Revolution Show. I am your host, Alex Theuma, CEO, founder of SaaStock. Delighted to be joined today by Raluca Ragab, who is Head of Growth for UK and DACH at Eurazeo. How are you doing, Raluca?
Hey, good to talk to you today. Excellent.
Good to have you on the podcast. We met a couple of months ago through a mutual acquaintance, and so lovely to actually have you on the podcast and speak to you again. And ahead of that, Raluca, we always start the show by getting to know our guests a little bit better about who they are. So would love to kick off with that and understand who is Raluca Ragab.
So Raluca, first and foremost, is just a girl from Romania who at some point set off to the US, studied there, and always dreamt of becoming an international human rights lawyer, but ended up being very lucky, landing on a desk at Goldman and learning about investing in companies when she didn't really know anything. And you know, it's been 21 years and never turned back. I have been the luckiest person to just spend all these 2 decades really just asking questions from much smarter people than me, which are the managers, the CEOs, the C-level execs, and actually getting answers, and then getting to actually, you know, apply judgments, think through things, and then see also how things change all the time. So, you know, rethinking through businesses and what makes them go forward versus go backwards. So yeah, now I happen to sit in a seat of Eurazeo Growth, and I run our UK and DACH businesses for growth stage companies.
Awesome. Funny or not funny story. When I was young, I went for an interview at Goldman, and I was 45 minutes late because I think I messed up the train times, and it was a boiling hot day. And so I ended up sort of rushing there and was very sweaty. And I thought the interview went well, but I didn't get the job. And probably because I was 45 minutes
Don't take
late,
it personally.
No,
most of us. I don't know if I would get the job again if I applied today at Goldman.
Yeah,
so,
but maybe I wouldn't have been here had I
exactly
got the job. So who knows? And so Eurazeo, tell us a little bit about who you are, who it is, and what data you can share about Eurazeo.
Sure. So Eurazeo Growth is one of the strategies of 6 strategies that Eurazeo platform overall has. So Eurazeo is a large asset manager, originally French, really truly global right now, spans offices from Asia to Latin America, US, wherever it might be. And it currently has about 35 billion of assets under management. Of this, about 5 billion have been invested by the growth team. And we're going to obviously talk a bit later about what growth really is. But we've basically are one of the oldest investors in growth in Europe at scale. So we've been investing since 2014 in growth stage companies in Europe. Those 5 billions are really just about like 35 to 40 quite iconic scale-ups in Europe. A lot of names you have heard about: Back Market, Vestiaire Collective, Dataiku, Doctolib, etc. And that's where we are today, and raising a new fund.
Awesome. Very good. And raising a new fund today, is it a little bit easier than it was maybe 12 months ago? Or with your track record at Eurazeo, perhaps there were not that many challenges?
Yeah, it's early days, right? We're ahead of a first close in what we hope is going to be Q1. And I think that it's, as everything, it's always really good for very good funds, and it's always really hard, right, if you're not performing. I think right now we have done a lot of changes to the team. I think we have a lot of things to look forward to in terms of what are the different ingredients that we're bringing together in the fund for to drive a lot of performance. So I think we're seeing very receptive LPs out there. And I must say we're also, as far as I know, the only growth fund in the world that is of scale, so kind of in the billion plus each fund, that is run by women entirely. So I think that's
awesome.
Also something I'm very proud of, and one of our key ingredients for success.
Awesome. I didn't know that. And it's a great well, it's not a great statistic, but it is great that that's the case. And you've been a growth investor since 2003, so quite a long time. Like, how did that start? And yeah, how is it going now? Like, maybe you can share maybe some of the changes you've seen during that time.
Yeah, I mean, I think that, look, we started out, my original background is in public equities. And what we observed in public equities was that innovation was really happening, let's say, under the surface, meaning in the private market. And then you'd end up kind of having a competitor list and you didn't actually really know anything about it. So my journey into growth equity started from understanding where is the edge of the innovation. I need to go there to understand how my public markets companies are going to be challenged, very soon. So it kind of helped that I came from kind of knowing what a very mature company really looks like a truly scaled company looks like, to what level of precision they have to deliver their earnings, which is a very different level of precision when you're in public markets. And then I moved to the growth stage. So a lot of what I do is I help companies kind of go on the journey of what they need to become to actually be successful, kind of really high scale companies. What has changed in all these different years is I think that the underwriting standards have really changed. I think that funds today do really, really strong due diligence. I think that investors in general are much more specialized, and I think founders also demand that, or at least appreciate when investors truly understand their vertical, so that the learning curve when they start talking about their company is not so steep. They're talking to investors that very quickly they become thought partners because they've done a lot of thematic work, because they've looked into it, because just pure experience. I mean, if you look at the people who were doing growth investing prior to the 2008 crisis, it was a handful of us. And this handful, at the time I was sitting in New York, we didn't have that much experience because the ecosystem had not gone through all of this. I've now seen all of the different ways in which companies make good decisions and bad decisions, in which we investors advise companies, give good advice and give bad advice. And I think it's this accumulated experience that's happened over the last 20 years that's made us better investors, all of us that we are in this industry. And I think it's also making founders more demanding because they understand that you could, on the other side of the table, have a lot of experience and draw from that experience.
Awesome. Like, in terms of your most recent, you mentioned some of the companies there. I heard Dataku, obviously WalkMe, Backmarket, and so on. Which, and maybe none of those, was the most recent investment? And maybe you can share like how you met them,
yes,
why you invested in this company, and how long it took to close such a deal.
Absolutely. So the most recent investment I closed in early June this year, is actually a German company that is becoming well on its way to move from being a regional champion, because they're doing very well in Europe now, to actually being a global winner, which is what we back. We generally back companies that have already proven not just one market, local market, but maybe a couple of international markets. Usually for European companies, that will mean you're German, you go to France, and you go to Scandi, for example, and they are really making the big step to the US, because you can't be a global winner without the US market. It's just a sheer size that you cannot ignore, right? A software company. So their name is Cognigy. They do conversational AI for the enterprises. And in layman's terms, it's just like you're automating customer service. All right, but we've all had these terrible chatbots that we've been fighting with, right? When you're trying to change your BA flight or whatever it might be, and they just don't work. And I think what Cognigy has finally cracked, because the underlying large language models of AI on which this is based have dramatically improved, is that they actually can now automate up to 70% of these requests from customer service. And they do it enterprise grade, because I think there's a lot of competitors. This is a big space. It's a huge TAM, and of course everybody can see it and everybody's going after it. So it is a big competitive market. But what they do well, so kind of if I go back to why did I invest, there were two main things. One is they do it enterprise grade. A Lufthansa, a BA, is going to have to go for a solution that's reliable, that's scalable. So if you have a strike at the airport and suddenly you have to do 200,000 parallel conversations with customers and not 2,000, can the system cope? And it's secure, right? Because obviously you're much more likely to get to try to get attacked. So it's enterprise grade. That's number one. And number two is really the founding team. I have spent a lot of time seeing a lot of visionary tech founders, and I think that we as investors are kind of over glamorizing, if anything, right, these visionary tech founders. But at the end of the day, when you come to growth stage, it's about building a business. You're beyond idea, you're beyond the vision. You just need to get a business going. That's processes, that's systems, that's scale, that's delivery. and it's just pure execution. And these founders are just down to earth execution machines. They've been in go-to-market organizations before, in successful software companies, so they know what it takes. They're not just thinking about the tech and the product, because sometimes you can get lost into kind of perfecting and optimizing the product. They're thinking about how to get in the hands of customers and to make those customers happy. And I think they're going to really win on the execution phase, and that's what delivers at the end of the day a big business.
What's the weighting that you would put on a visionary founder, like at this stage? Like when you're, I don't know if you have like a scorecard, but like, is it 50% of the importance? Like, how do you view that?
I think a visionary founder is needed if you want, again, a global win. If you want a real platform that stays independent, that doesn't do a quick sell, sells for 500 million tomorrow to some SAP, then you do need a visionary founder, because at the end of the day, you need to think how you keep evolving this product. But I would say that to me is at best 50%. The other 50% is, are you a good process person? Are you a good execution person? Do you understand what it takes to deliver this? And it's really hard, and it's tedious, and it's obviously the less exciting part of the job. But understanding when to bring the right COO, understanding when to bring the right CFO and beefing up that finance function, etc. What process to put in place, what sales enablement to put in place. I think that's 50% for me of delivering a real successful company.
Awesome. And so we want to go, I guess, sort of like dig deep in what it takes to build a successful growth stage company, and therefore potentially, get the right investment. So if we start about the criteria, and obviously we just sort of mentioned there about the visionary founder as well. But when you're looking at, like, I guess, kind of like metrics and criteria, what is it that a growth stage company needs to be successful?
Yeah. I mean, if we think about defining growth, you're basically outside of the period when you're just finding your product market fit and you found 5 to 10 million of revenue. That means you will kind of have a sufficiently diversified customer base, enough people to whom you are delivering real ROI, because that's really what I care about. What's the ROI on this product that you're delivering? And you are now ready to scale. So you're out of the startup phase and you're into the scale up phase. And you're now ready to kind of, you know how to do it. So the formula is there. Right? Every company should have a formula in mind. This is how I make money, right? This is my ideal customer profile. That's my price times my volume. That's how I scale it. That's how I deliver it. That's the number of salespeople I need in order to become a 100 million revenue business, 300 million and on. And then this equation needs people around it, needs actually to just expand so that you're able to maintain high growth at scale. So I would basically say that at growth stage, you basically, if I think of a metric, you're somewhere in the zip code of 10 million of annual recurring revenue. That would be a good metric, because that's kind of a late Series B, early Series C. That's kind of where growth moves, right? And, that's one of the main metrics. I mean, for me as an investor, another way to think about it is, how much of a track record do I have about this company delivering with certain unit economics, so that I can actually make real predictions about the model going forward, the financial and operational model going forward. And usually I will need a few good quarters. I'll need 4 to 6 quarters of seeing, which really again puts you in the 10 and even more kind of towards 15 million of ARR, because you kind of need to have enough of those data points to see actually what's truly recurring, what is not, how does the business actually kind of move. So I think those would be kind of the main metrics, right? Usually people define it in the Series B and C and onwards, right?
What about some of the common challenges that you see then also at that stage? Yeah. And how do you I guess, kind of work with the companies to help them overcome them?
Yes. I mean, yeah, two very good questions, because, challenges are multiple, right? Ultimately, you're coming from a place, usually it starts with the founder, and the main challenge is learning to delegate, because until now he's been on top of every single detail. At this point, your sales organization explodes, right? You start having AEs all over the place, then you have to have your BDRs, etc. So you kind of, you're not on top of every account. You're not selling to every client yourself. You're not in every pitch anymore. So, for a founder, it means, who do you bring in place that you trust and you can give them enough free hand so that it's still your company, still your baby. And by the way, there was that entire speech by the Airbnb founder about staying in all the details, right? So most founders are going to want to stay in every detail, but realistically, it's impossible to stay in every detail. So what kind of elastic band do you create because if you bring talented people need that freedom. You cannot be micromanaged, right? So I think initially is this tension and the founder finding his balance of, okay, how much am I involved and how much do I bring a really capable person from the outside? How much do I extend this trust? Sometimes you're promoting internally, of course. I would say that, promoting internally works, but I think, it works when you're at 10, 20, 30 million of ARR. There's a moment around 50 when you can't just do that. You need people who have seen what I would say the movie play. That means they've already scaled in another business. They've gone to 250 million of ARR. They want to come back to the journey again between 50 and 250. And you need those people because you want to shortcut your learning curve, right? You want to just not make every single mistake that every first-time founder is making or every first-time kind of startup is making. So you actually wanted those kind of people. But that takes a lot of trust to bring somebody from the outside that wasn't there with you from day one. So I think it's first the founder finding that balance of delegating versus being very involved and of what type of person they bring. In my experience, the challenge comes that people bring capable people a bit too late. They realize, damn, I now need a CRO. But a CRO search takes a year maybe, and you needed it yesterday. So you are kind of losing a year, if you will, or you're going to hire suboptimally because you say, I need it now. And that happens a lot more in functions like, let's say, the finance function. I need a VP finance now that's much stronger, or I need an early CFO, and you're hiring too fast, right? And you're not hiring the right person because you needed it yesterday. So you did not anticipate. So I'd say anticipating your people needs is crucial, and that really will impact your ability to deliver at scale, because delivering 50 or 80% growth at 50 million of ARR or at 100 is dramatically harder than going from 5 million to 10 million ARR. Just the absolute numbers are big. So that's the first kind of challenge. The second challenge is you start running, many times you've kind of picked the low-hanging fruits. You've solved to the ideal customer profile that was kind of obvious. Then it gets harder. So your sales efficiency starts kind of faltering, right? You're not really, you have to think again, or you have to expand your product. You have to deliver more customer service. Customers are demanding. You start having churn cycles, right? All the guys that you onboarded when you're at 5 million, and maybe some of them you even managed to get in for a couple of years contract because you gave them a better pricing. All right, they're going to start churning, and you need to kind of, how do I keep them in? How do I keep them in happy? So I think these are the main challenges that I see as companies embark on this journey. But it really starts and ends with people. I've rarely seen software companies disappoint because of the product. Usually the R&D organization has very clear, the R&D roadmap is there, they deliver. That machinery usually works. And that goes back to the visionary founder who always loves the tech. They usually underperform on the go-to-market, on commercializing it, right? And on setting up a real organization, on bringing people, but also retaining people. It's hard to retain very good performers. So you kind of don't want to become a kind of revolving door, a lot in and a lot out. So it really goes back to people. Those are the biggest challenges. So maybe how do we help people? How do we help companies? Yeah, look, I firmly believe that us as finance people, because I've only sat in front of spreadsheets my entire life and on board. So yes, there's a lot of experience to bring, but at the end of the day, I've never been in the trenches running a business. So I think that my help kind of is very limited, and I'm always very happy to offer the founders, again, people who with real operating experience. And I think what Europe lacks a bit is having enough global winners, enough champions where people have already exited, they've made their good money, and they are now returning and picking up a new journey from the beginning. There's just not enough of them, right? It's concentric circles. You have the first success stories, the delivery heroes, the Addians, the Spotifys, they exist. Then you have their C-level executives who have founded other companies, or they again restart a journey as CRO, CMO somewhere else. But these concentric circles are just bigger in the US. They're a bit smaller in Europe. So we need to pick from this smaller circle of people that have managed to be in very scaled organizations and bring them into the much smaller ones. So for us, they're called operating partners. So we have the former CTO of Klarna, who was also CEO of Expedia at IPO. He's one of our operating partners. The former GM for all of EMEA for PayPal, he's also an operating partner. These guys are bringing, just bringing that experience of what are the things that really get hard at 100, at 500 million. And they can have a dialogue with a founder that's just very different. One, because the depth of what they can go into operation is very different. Second, the respect they command. I'm just one of their board members. I'm one of the finance people that they keep talking to. They talk to somebody that has done it in a company they admire is very different. So we try to embed these people. They spend 1 day a week with us. They're getting paid 1 day a week. And they will basically be deepening relationships with 2, 3, 4 portfolio companies. But with those, they're going to have a more sustained dialogue. So it's not kind of a nice figurehead on a PowerPoint presentation. Here's my advisory board. Here are operating partners you could be reaching out to, but you maybe get a call a year. You actually get to develop, with them a relationship and to take a potential challenge and brainstorm about it, try a solution, come back. So it's a much more frequent dialogue. So I'd say these people talk, multiple times a month over the year with our 2-3 founders that find their particular expertise helpful.
And maybe I should have asked this earlier, but it does feel still like a nice segue in terms of what is the difference for our audience between growth investment and then classic venture capital. So if you mentioned 10 million, you could be like Series B, Series C. Like, why take growth investment versus doing a Series C round with a large tier one investor, which you probably do. You probably do both, right? But
so I think it's just a matter of definition. Venture capital tends to actually focus up to be and included, right? And it's more about the shape of the risk that venture capital investors take. We just call it growth because the companies are just later stage actually. So it's in that continuum. It's a continuum. You kind of are in pre-seed to Series B. Everybody there is a VC. You're also a VC, but you're a growth stage VC. When you're kind of doing later stage, where things are kind of muddy is this BC, because you have VC guys do B and even a C, and you have growth stage guys that come from this later DNA, right? Like when companies are much kind of more baked, if you will, who also do BC. So you kind of have, this is the ground where they meet, right? It's just but it's more the DNA of the investor and the type of work they will do. What happens with companies is that they'll find that a specialist growth stage investor, so a later stage investor, will honestly be a pain for a Series B, because the kind of questions we ask, the kind of all the customer databases that we ask, and all the details that we need from them operationally, at some point can be quite overwhelming. Because we underwrite lower returns, right? So we will not underwrite that we're ever going to make 100x on something. In fact, a 10x is quite kind of rare to actually really achieve in growth. You may want to underwrite 5 to 10, but realistically to achieve is much harder. Whereas obviously in VC, they underwrite much higher returns, but they're also used to a long tail of businesses that it's okay if they don't do well, because they'll have the compensation factor from the really high return one. So we just make decisions slightly differently, and we meet in this BC, but let's say at D, you're not going to really have that, right? You kind of just are going to have the classic specialist growth stage investors that are all number driven, that are looking at all those quarters that I was talking about, and they're asking a million questions, and they're running a ton of calculations on your customer database.
And when we look at, I guess, maybe the last 18 months, sort of like growth stage funding really sort of slowed down, maybe ground to a halt. As such, only the best we were seeing, like a Muse, for instance, they got to their $1 billion valuation raising. I think it was their Series D or something like that, and some further sort of growth investment. But it's been few and far between, and obviously we've had a lot of headwinds, certainly within SaaS over this period. How do you foresee the next 12 months in SaaS, and especially around growth investment? Any good news to share?
Any good news? I do think there's good news, because I think that what you have now is a tale of two types of companies. You've got the companies that grew up in the heydays of 21, 22, and they got bloated cost structures, which they've been just obviously compressing for the past 2 years. But a lot of them actually maybe should not have gotten funded, because in fact, maybe the unit economics kind of never worked. And they got funded because people were willing to overlook the inefficiencies, right? And they were willing to overlook kind of businesses that would burn for a very long period of time in some promise of improving. Those guys are struggling. Some will never do well, and some have rebased their cost base, but they are, in many cases, has come at the cost of being lower growers. So they're a bit in a limbo, because they're coming up, because their last valuation tends to be quite high. So unless they accept a flat valuation, because they maybe are barely growing into their previous valuation or a down valuation, they don't tend to be so exciting. But there are good news. If you think of all the companies that had to raise a seed or Series A in 22 when it was hard, in 23 when it was super hard, and even in 24, anybody who's been successful to do that and is now graduating, right? So maybe they were a 1 million company in 22 and they're 5 million in 23, and they're now kind of becoming a growth stage company. those companies, they were so scrutinized, they found it so hard to get funded, that actually they have much stronger unit economics, they have great stories, and they know how to deliver growth without having a bloated cost structure. So I do think that there's a second wave now of these companies that had to go through this kind of much harder time funding in their earlier stage, and they never got to, to be inefficient, because they were so small originally, right? They were just a Series A in 23 maybe, and that they just kind of got the basics and the fundamentals right, and they're going to scale off a much more reasonable set of unit economics and cost structure. So I think there's massive, like when I look at the opportunities I'm looking at right now, it's really incredibly bifurcated. I have super late stage companies, which are the very few and far between, are managing to maintain let's say a 35% growth at scale at 250 million with good economics, like they are profitable. That's so few of them. Most have failed at promise, right? So you can invest in those because they've proven the execution. Of course they slow down. Of course it's only 30%, but at 250, 300 million in revenue, that might be okay when you look at public market comparables. And then I have nothing in between. And then I have like only a ton of Series B, a really exciting Series Bs and Cs. There's a lot that are going to come to the market over the next 12 months, who are really the babies of 22, who had a hard time when the market shut down in 22. Whomever managed to get funded back then was a really good company. So they're making it through and they're growing. So I think there's really good news, yes.
Good to hear. And let's move into the quickish fire round, Raluca. So what one thing has moved the needle the most for you in your career?
Raising my hand. When I was junior, and when somebody asked, do you want to do this? Do you want to do this? Just raise your hand always. It will just move you forward. It will create a lot of goodwill in an organization. It's painful, but it really, people appreciate people who say, all right, I'll take this. I'll take care of this. I'll do it.
What about best advice you've ever received?
It's high school. I thought about it today when you sent that question, and I really was thinking, my God, which one it is. It's high school, so maybe kids will appreciate it better than me. But I use it today, which is when I came into like high school. So I started first grade of high school, so ninth grade back in Romania. Our kind of advisor said, do your homework the day it's assigned, not the day before it's due. And you can apply that obviously more widely, because this way you're never running out of time. And just doing things, just getting things done, to never do things last minute, it allows you the time to think. Because if something takes longer, you're never doing it against time. So it allows me a degree of control over my life. I don't feel that the deadline controls my life. I feel that I control when I'm doing things, and I have time to think. So it's a ninth grade advice, but it works at 44 also. It's
good advice, and I wish my kids, well, I'll try and draw that into them every day. I mean, they're young, they're 8 and 9, but when they have like their spellings that they have to submit, they do it on the morning that they have to submit it, and then it's a rush
and then it's a stress. So I'm trying to do the same with my kids, and then I try to remind them when they actually have something due the next day and they're done. I'm like, isn't it awesome that you're done? And you're like, all right, I'm chilling now, I don't have anything to do.
I'm trying, but it's always tomorrow. What about biggest failure you've made and lesson learned?
I think it's been investments where I invested despite the founder's character. I think you really cannot underestimate. You can have the best asset, best product, but the founder and the management team more widely, obviously, but obviously the key executives are going to really, and the times when I said it's a great product, the customers love it, okay, this guy, and by the way, each time was not necessarily about their ability to execute, was their ability to listen and to be humble about what they might be wrong about. Founders who don't take advice don't have the ability to step back and be open to listening and to understand that they still have a lot to learn. I think having a hard time to change course when they're going into a certain direction, because people might be telling them this, but they're not, and they change course too late. And by that time, they've missed something, they've fallen behind competition, etc., whatever it might be. And I've done this twice, and I promised myself not to do it. And so the bigger mistake is that I did it twice, not that I did it the first time. Just never hope that they will change, because this is a character trait that doesn't change. So, invest in people who listen and who are humble enough to understand when they may just have something to learn and correct.
What about hardest thing about building a SaaS company today?
I think the hardest thing is that the barriers to entry to software development are lowering with Gen AI. So I think the barriers to entry for competitors are becoming quasi-zero. It's about getting the right people in the company, and then it's about getting it to customers and making sure customers get the value from it. So having really strong customer success teams and making sure you're sticky, because there's going to be a lot of competition with a lot of Me Too products. It's going to be very hard to differentiate on the tech, on the product itself. So then how do you create stickiness and you don't just have a high churn business? It's going to be with, really listening to your customer and delivering the ROI that they exactly need and having that customer success.
What do you think, just on that, about, and I think I'm right here, but like Snowflake, whether I was sort of reading Frank Slootman's book, and I think they didn't quite believe in customer success and got rid of those roles. Any thoughts around that?
So I don't know what the book specifically says because I haven't read it, but I think that, customer success is not needed if you don't oversell your product initially. So if you're very clear and if you have a very easy to use product and you don't oversell what's going to do and the customer sees the visible ROI very fast, then sure, you don't have to go back and handhold him into using it, into kind of delivering that ROI if you may have oversold what it actually does for the business. So yes, if you sell correctly and if it's an easy to use product, intuitive, then you may not need customer success.
Last one, what is your favorite book and why?
So I only read books on politics and history, so it's going to be a boring one, but I love it. But I really recommend it to everybody because it applies to today. Francis Fukuyama, he's a professor at, I believe, Stanford University. He's written a lot of books, and the most recent one from this year, I think, is called Identity, and it's about the struggle for recognition of different groups and the cultural wars that are being fought everywhere between far left and far right in Europe and in the US, and it's just so eye-opening. I recommend everybody to read it. So Identity by Francis Fukuyama.
Awesome. We're going to add that to the list. And Raluca, where can people find you online if they want to reach out, if they're crushing it, they're at 10 million, or they love the podcast, or they want to reach out to you?
Absolutely. Where's best? Ping me on LinkedIn. I don't check it daily, but I check it enough that for sure I will be responding. So Raluca Ragab. There's only one of me because I have a funky name. It's half Romanian, half Egyptian. There's no other one out there. It's easy to find me.
Very cool. Very good. So two firsts. First and only Raluca Ragab, and the first time that we're seeing this talk at SaaStock. Awesome. Thank you so much, Raluca, being a great guest. I really appreciate you joining the SaaS Revolution Show and sharing with the SaaStock community. It's been very informative.
Fantastic.